So whether you have $3,000, $30,000, $300,000, or $3 million, this is a very valid question. How much money do I need to have to invest in real estate? Basically, we're going to boil it down to three things that this is going to kind of hinge on. Number one is your risk tolerance. Some people have a high tolerance for risk, other people have a very low tolerance for risk. Luckily, real estate assets don't carry as much risk as some other things like potentially stocks, which could go to zero. It's unlikely that real estate could do that. Even though in the last Great Recession, we did see a huge dial back in equity in houses. People lost 50% of their home's value, which is a lot, but there's always that risk. But it still held some of its value. It tends to, over the long haul, be a relatively safe asset to invest in. But you still need to ask yourself the question, how much can I afford to lose? If you're investing in something, you kind of have to look at it from the worst case scenario sometimes, just to protect and mitigate that downside that could potentially be there. What's the worst that could happen? Maybe we're at the height of the market right now. It just continues to chug along for some reason. The supply and demand is out of balance, and so prices keep going up. So some people might think, well, they're going to keep going up, while others might think, kind of like me, we're probably at the top, near a top. It has to bottom out at some point, especially if there's going to be a bunch of foreclosures after all this unemployment shakes out over the next year or two. So there is risk involved with real estate. That's why it's important to buy it right. So you do need to ask yourself the question, what can you afford to lose? Because you're probably going to lose some money at some point for a duration of time in a real estate asset. It's just a matter of if you're going to stay for the long haul or take your hit, move on, you learned a lesson. Overall though, real estate really is a very forgiving asset class. So the other question you have to ask yourself about your risk tolerance is, how much leverage are you comfortable with? Now, just to define leverage real quick, it's basically using other people's money, in this case, the bank's money, to secure a mortgage on a property. With a conventional loan, you're going to be putting down 20%, something like that, and the bank will fund the other 80% of the property. So that's called leverage. You're leveraging the bank's money to be able to purchase an asset, which is a really cool thing about real estate. You can do that. You can technically do it with stocks, but it's a little riskier. So how much leverage are you comfortable with? Some people want to own a property outright, and that's fine. Maybe you just want to own one rental property free and clear. You've got the funds to do that, or will in the future. Want to own it free and clear, no mortgage. All I have to worry about is, taxes, insurance, and some other expenses along the way, but you'll have a lot more cash flow. Whereas other people want to leverage as much as possible, even to the extent where they're using other people's money to fund part of the project too. So they might have some of their own money, some other people's money if they're investing with some friends, business partners, or even a larger syndication like for an apartment building, and using the bank's money. So a lot of people will go that route where they get leverage and they're able to buy a lot more, but they have a little more risk there because they're leveraged pretty highly. So figure out what your risk tolerance is. Low, high, somewhere in the middle. Figure out what that is and start with that. So point number 2 is your strategy. What is going to be your strategy with real estate investing? There are many, many different ways to go with this. The first two that I see are the most common for new investors especially, and for just a lot of investors in general, are fix and flips or long-term rentals. And that's pretty much where I've stayed at for the most part. There are other things you could get involved in, like commercial real estate. You could get involved in note investing, investing in liens and things like that. But for the most part, people are looking to invest in either a fix and flip, where you buy a rundown house, fix it up, sell it for a quicker profit, or a long-term rental, which is the typical buy a property, put tenants in there, manage the property, collect the checks. So knowing your strategy is going to be really important going forward too, to figure out how much money you're going to need to invest in real estate. If it's a fix and flip, you're going to need a lot of money to not only purchase the property, but to fix it up. So how are you going to come up with that money? Do you have enough money to cover both the purchase, like say the down payment if you're using a conventional mortgage, plus the rehab costs? Are you going to have to use a hard money lender where they're going to carry a lot of those costs but at a much higher price to you? Are you going to use partners or other people's money, bring them in so that you can do these fix and flips maybe at scale? A little bit different way of thinking about it. The thing with fix and flips too is some investors don't really consider it investing. It's a short-term gain, and you're gonna have to pay capital gains on most of those properties because you're disposing of them in a shorter period of time. So it's one thing to think about, but I do like that strategy getting started because you're gonna make some good contractor connections. You'll learn the process of doing a rehab, managing a rehab, and that's really helpful just across the board to know some of those things. In fact, if I was a new investor, I would start out by doing probably 2 fix and flips and then buy a rental and kind of continue that process. That way you have some money to live off of from the flips, but then you also reinvest that money that you're making from the flips into a rental property. And if your strategy is just going to be straight out rentals, you're just going to buy rentals, you just have to figure out, am I buying kind of like a turnkey situation? Will there be a rehab needed? Are we going to house hack, which is a great strategy, especially if you have lower funds, which we'll get to in a minute. But no matter what your strategy is, there's a way to make it work, whether you have a little money, medium amount of money, or a lot of money. So let's talk about that. So with point number 3, if you have small, medium, or large amount of money saved up. Let's just start with small. So let's just say you have a few $1,000s saved up, but you want to get into real estate investing. I wouldn't recommend going out and using other people's money, getting over leveraged to get involved in your first deal. I would try to learn a little bit more, but I think the best way for a newbie to get started with this is to house hack. So if you're not familiar with house hacking, you buy anywhere from a 1 to a 4 unit property. You can use an FHA loan, put down as little as 3.5%, and then you can rent out the other rooms or the other units and practice being a landlord. And a lot of times all the rent from the other units are going to cover most, if not all, of your expenses for the property, and then you can go ahead and do that again in the future as well. So that's a great way to get started if you have just a little bit of money. Now, if you have a little bit more money saved up, or maybe you have some equity in your home, and you can do a home equity line of credit or a HELOC, and you have access to some funds to invest, again, goes back to your strategy. Are you going to do fix and flips or rentals, or maybe a combination of the two? But if you have a medium amount of money, you can reasonably buy in a lot of areas of the country if you want to invest close to home, or maybe you're in a really expensive market and you have some funds, but maybe not enough to get involved in your market right now. Maybe you look outside of your market, which a lot of people are doing. There are a lot of great markets across the country that you can invest in. And if you have a large amount of money, that gives you a lot more options, obviously. You could be a completely passive investor in this case. If you're an accredited investor, maybe you go in on some of these apartment syndications, stuff like that, write a check for $50,000 or $100,000 or more, and get involved that way, and you can actually kind of learn how that process works. But that's a great passive way to enjoy some real estate investing. Or you could just get in some larger deals. You could buy a smaller apartment building. You could partner up with some people, take down some bigger deals this way. Or you could buy maybe a more modest property, all cash, and have that cash flow coming in right away. So think about those 3 things. What is your risk tolerance? What's your strategy going to be? And how much funding do you have? Combine those pieces together and you'll be able to make a real estate empire over time. I was going to say in no time, but it does take time. So anyway, guys, good luck with that. Let me know if you have any questions, and we'll see you next time.